May 17, 2023. Wednesday morning in Miami Beach. The causeway glitters with eastbound traffic. Construction cranes rotate slowly over Brickell Towers. At a Starbucks on Collins Avenue, someone orders an iced latte while checking their phone. In Coral Gables, sprinklers hiss across manicured lawns. The sun climbs into cloudless blue. Everything looks permanent. Inside a downtown office building, an envelope arrives. Standard business mail. White paper, window front, return address from an insurance company in Tampa. The kind of letter that usually sits unopened for days. Inside, 3 paragraphs. Professional language. Regret to inform. Policy non-renewal. Effective 60 days. No explanation beyond risk assessment recalibration. The building is 87 units, $40 million in mortgages. The envelope weighs less than an ounce. Across the city that morning, similar letters. Not thousands, not yet, but dozens. Condominium associations, property management companies, commercial buildings. The letters don't make news. Insurance correspondence never does. Some recipients call their brokers immediately. Others assume it's negotiable, fixable, a mistake in the system. By noon, most of the letters are filed away. Life continues. The ocean stays calm. Nothing has visibly changed. But something has begun. Insurance is infrastructure nobody sees. It exists in documents, premium payments, policy numbers entered into mortgage paperwork. You prove you have it when you close on property. You renew it annually, sometimes noticing the price, usually not. It functions like plumbing, invisible until it stops working. For decades in Miami, it functioned. Hurricane Andrew in 1992 damaged the system but didn't break it. Companies paid claims. New regulations emerged. The market adapted. Florida created Citizens Property Insurance Corporation, a state-backed insurer of last resort, meant to be temporary support. It became permanent infrastructure. By 2020, Citizens covered over 600,000 policies statewide. The number kept rising. The system operated on assumptions that risk could be calculated, that premiums could cover claims, that reinsurance markets would remain stable, that the past predicted the future. Every assumption worked until it didn't. Miami's insurance market wasn't one thing, it was layers. Private carriers handled standard properties, surplus lines covered higher risks, Citizens caught whatever fell through. Reinsurers backed the entire structure, spreading Florida hurricane risk across global capital markets. The system seemed robust because it had depth, multiple fallback positions. What nobody advertised was that each layer had become thinner. People didn't think about their insurance the way they thought about their mortgage or property taxes. It was automatic, invisible, handled by the condo association or built into escrow payments. The protection felt permanent because it had always been there. That permanence was about to be tested. The premium increases started years before the letters. 5% annual rises, then 8, then 12. Condo associations noticed but absorbed the costs into monthly fees. Residents complained about rising HOA payments without understanding why. Insurance was one line item among many: maintenance, utilities, reserve funds. The increases seemed annoying, not alarming. In 2021, premiums jumped harder, 15%, 20%. Some buildings saw 30% increases in a single renewal cycle. Association boards called emergency meetings. Residents demanded explanations. The explanation was always the same: the market. Hurricane claims from previous years, reinsurance costs, risk models. Nobody could do anything about the market. By 2022, some buildings couldn't get renewal offers at any price they could afford. A mid-rise in Sunny Isles received a quote for triple their previous premium. They shopped for alternatives. 17 carriers said no. Citizens offered coverage at rates the association couldn't pass to owners without financial revolt. They accepted it anyway. What choice existed? The pattern wasn't universal. Newer buildings with impact glass and reinforced construction still got reasonable rates. Older structures, anything built before strict building codes, faced escalating costs or outright rejection. Location mattered. Coastal properties paid more than inland. Elevation mattered. Buildings in flood zones saw compounding increases. The market was sorting risk in real time, building by building, block by block. Policies that renewed came with changes: higher deductibles, lower coverage limits, exclusions for specific types of water damage. The protection was eroding from within, becoming less comprehensive even as it cost more. Few people read the updated policy documents carefully enough to notice what was disappearing from coverage. The non-renewals arrived quietly throughout 2023. Not a wave, a steady accumulation. Buildings discovered they were uninsured during routine administrative reviews, a property manager preparing annual budgets, an accountant reconciling insurance expenses, a title company processing a sale. The gaps appeared in paperwork before they appeared in reality. Some buildings went weeks without coverage while scrambling for replacement policies. Technically illegal under condo association bylaws and mortgage requirements, but what enforcement existed in the gap between cancellation and replacement? Associations paid whatever price they could find. A building in Miami Shores went from $60,000 annually to $240,000. Monthly HOA fees doubled overnight. Owners received special assessment notices. Some couldn't pay. Some refused to pay. The buildings without any coverage at all stayed quiet about it. Admitting uninsured status could trigger mortgage defaults, tank property values, create panic among residents. Better to keep searching, keep negotiating, keep the situation contained. Several high-rises operated for months with coverage that had lapsed, boards hoping to find a policy before anyone noticed or asked or something happened. Citizens absorbed more of the market by necessity. By mid-2023, the state insurer carried over 1 million policies, far beyond its intended capacity. It became the primary insurer for coastal properties across Florida. What was designed as a safety net had become the foundation. And Citizens itself faced financial strain. Its rates couldn't cover its exposure. It existed because it had to, not because it was sustainable. Nobody rang alarm bells. Insurance industry newsletters mentioned market tightening. Local news ran occasional stories about premium increases. Real estate agents assured buyers that coverage was available, just more expensive than before. The system appeared to be adjusting, adapting, continuing. The buildings all still stood, the cities still functioned, but protection was silently being withdrawn. Mortgages require insurance, not as a suggestion, as a legal mandate written into every loan document. Proof of coverage, specific minimum amounts, deductibles within certain ranges. If coverage lapses, the mortgage holder can force place insurance and bill the borrower at whatever cost. If no insurance exists at all, it triggers default provisions. This is where invisible problems become structural ones. A family in Aventura bought their condo in 2019. Standard 30-year mortgage. When their building's policy wasn't renewed in 2023, the condo association struggled to find replacement coverage. Weeks became months. The mortgage company sent notices. Insurance must be obtained. Proof must be provided. The family had no control over this. The building's master policy wasn't their responsibility, but the mortgage clause didn't care about responsibility. Multiply this across buildings, across units, across the entire geography of exposure. Banks started noticing gaps in coverage on properties securing their loans. Some demanded proof of renewed policies. Some began foreclosure procedures on units in uninsured buildings. Not many, not yet, but the legal machinery existed and could be activated. For new buyers, the problem was simpler and more brutal. You cannot close on a mortgage without proof of insurance. If a building cannot obtain insurance, units in that building become impossible to finance. Cash buyers only. The pool of potential purchasers shrinks instantly. Property values respond accordingly. Sellers discovered this during listing periods. Interest from buyers, offers submitted, then the financing stage. The buyer's bank requests proof of building insurance. The condo association cannot provide it, or can only provide Citizens coverage with a deductible so high the bank rejects it as insufficient. The sale collapses. The cycle repeats. Units sit on the market. Prices drop. Still no buyers with financing. Some buildings existed in a strange limbo, covered but barely, insured but at levels that didn't meet mortgage requirements, protected on paper but with exclusions that made the protection nearly worthless. The gap between having a policy and having adequate coverage widened into a chasm the mortgages couldn't bridge. The requirement was working exactly as designed. Lenders needed assurance that their collateral was protected. Insurance provided that assurance. When insurance disappeared, so did the lending. The system wasn't broken, it was functioning perfectly, revealing risk that had always existed but was now uninsurable. Miami continued looking like Miami. Cranes kept building, restaurants stayed full, traffic clogged I-95 every rush hour. From the outside, prosperity. From the inside, a sorting mechanism had activated, determining who could remain, who could afford to enter. Who was being quietly priced out, not by rent or property values alone, but by the disappearance of protection. The division wasn't about wealth exactly. A penthouse owner in an older building faced the same insurance crisis as a modest condo owner in the same structure. What mattered was the building itself, its age, its construction, its location, its elevation. The risk profile the insurance market had decided was acceptable or wasn't. New construction still attracted coverage. Buildings with the latest hurricane-resistant features, concrete instead of wood frame, impact-rated windows and doors, elevation above base flood levels. These properties could still get competitive insurance rates. People who could afford units in these buildings continued buying. The market for new luxury condos remained strong. Older buildings, even in desirable neighborhoods, faced different mathematics. A 1970s mid-rise in South Beach couldn't compete with insurance costs. The building had value, the location had value, but the structure itself was now a liability in ways that couldn't be renovated away, not without reconstruction so extensive it would be cheaper to demolish and rebuild. The economic geography of the city was redrawing itself along the lines of insurability. Areas with newer construction became relatively more valuable. Areas with older building stock became relatively less viable. Not abandoned, not yet, but marked by the market as higher risk, harder to finance, more expensive to maintain. Renters felt this too. Landlords facing quadrupled insurance costs passed them through. Rents increased not because of demand, but because of expense. Some landlords sold rather than deal with the insurance crisis. Some buildings converted from rentals to condos, shifting the insurance problem to individual owners. The rental market tightened further. People who couldn't afford to buy also couldn't afford to rent. The mechanism was efficient and merciless. A city that looks fine, but isn't protected, operates in a specific kind of denial. The risk hasn't materialized yet. The hurricane hasn't hit. The building hasn't flooded. Insurance seems like an abstract concern, expensive paperwork, something people complain about but don't fundamentally worry about, until they need it. The gap between appearance and reality grows widest in the calm periods, between storms, between claims, when everything functions normally and the absence of protection feels theoretical. Miami in 2023 and 2024 existed in this gap. Tourist numbers stayed strong. Real estate transactions continued, new businesses opened, the skyline kept changing. From street level, from tourist perspective, from promotional materials, the city looked like it always had, vibrant, growing, valuable. But underneath, the foundation had shifted. Risk that was previously distributed across insurance markets had moved back onto property owners. Individuals now bore exposure that used to be shared. The protection that made owning property feel safe had eroded or disappeared. The buildings themselves hadn't changed. Their vulnerability was the same as before. What changed was who would pay when that vulnerability became reality. People adapted in small ways. Some bought separate flood insurance, wind insurance, trying to piece together coverage from multiple policies. Some increased their emergency savings, self-insuring against smaller losses. Some simply accepted the risk, hoping for the best, unable to afford alternatives. The city didn't feel like a crisis because it wasn't one yet. It was a condition, a new normal. Higher costs, more risk, less protection. People absorbed it the way they absorbed other inconveniences. Complained, adjusted, continued. What happens after the next storm is not hypothetical. It's mathematics. A major hurricane makes landfall. Buildings sustain damage. Wind tears off roofs. Storm surge floods ground floors. Windows shatter. Water intrudes. The damage is extensive, but not catastrophic, repairable. In previous decades, insurance would cover most of it. Deductibles would be paid, repairs would begin, buildings would be restored, the cycle would continue. Now, the equation has changed. Buildings with high deductibles face massive out-of-pocket costs before insurance pays anything. A building insured through Citizens with a 5% deductible on a $20 million policy owes $1 million before coverage begins. Condo associations must collect that from residents, special assessments, emergency fees. Owners already stretched by increased HOA costs now face five-figure bills for storm damage. Some can pay, many cannot. Buildings without adequate coverage face worse scenarios. Partial coverage that doesn't rebuild what was lost. Exclusions that deny claims for water damage or wind damage or both. Policies that cover the structure but not individual units, leaving owners responsible for interior repairs. The financial stress fractures communities. Buildings that take years to repair. Units that sit damaged and uninhabitable while insurance disputes drag on. Owners who walk away from mortgages rather than pay for repairs on properties they can't live in or sell. The damage from the storm itself might be manageable. The financial aftermath is what breaks the system. Foreclosures increase. Property values in affected areas collapse. Banks become more cautious about lending in Miami entirely. Insurance companies that remained in the market exit after paying claims. Citizens, already overextended, faces claims it cannot fully pay. The state government must intervene with emergency funding or allow the insurer to fail. Either option has consequences. The storm doesn't destroy Miami, it reveals what was already true, that the protection had disappeared, that the risk was real, that the appearance of stability was not the same as actual stability. Miami today sits in the window between realization and consequence. January 2026. The insurance crisis is acknowledged but not resolved. Citizens Property Insurance now covers over 1.2 million policies statewide. Private insurers continue withdrawing from Florida markets. Premiums continue rising. Some buildings remain uninsured. Others are barely insured. The city still attracts new residents, new development, new investment. Property values in certain areas remain high. Construction continues. The contradiction isn't subtle, but people live inside contradictions all the time. Miami is desirable. Miami is expensive. Miami is also increasingly exposed. All three things are simultaneously true. The wealthy still buy oceanfront penthouses, accepting the risk or self-insuring. Developers still build luxury towers, calculating that demand will outlast concern. Tourists still arrive in millions, unaware of the infrastructure stress beneath the surface. The question isn't whether Miami will exist, it will. Cities don't disappear from insurance problems alone. The question is what kind of city it becomes. One where only the wealthy can afford the risk, where property ownership requires cash reserves most people don't have, where buildings gradually deteriorate because maintenance and insurance costs exceed what communities can sustain, where the gap between protected and exposed widens into permanent economic division. The insurance crisis is not the hurricane. It's what makes the hurricane unsurvivable for the financial systems that support the city. Miami looks normal today because the storm hasn't come yet. The buildings stand, the ocean shimmers, the cranes rotate against blue sky. Everything appears fine, but the protection is gone, and eventually it will matter.